Hey everyone, so I just came across this absolutely incredible thread from Raoul Pal on X, and I had to share it with you guys because it completely backs up what I've been thinking about crypto markets. This data is seriously mind-blowing. Now, if you don't know who Raoul Pal is, let me tell you, this guy is a legend. Former Goldman Sachs executive, founder and CEO of Global Macro Investor and Real Vision, and he's got 1.2 million followers on X, for good reason. I've personally learned so much from this man over the years. Plus, he's been holding XRP for about 5 years now, so you know he gets it. But here's the thing that gets me excited. This thread perfectly shows why we haven't even come close to seeing crypto's peak yet. And for all my XRP holders out there, the best days are absolutely still ahead of us. Listen, I genuinely believe XRP is going to have that face-melting, euphoric blow-off top that we've all been waiting for. I mean, we've been patient for nearly a decade, right? It would make zero sense for it not to happen at this point. Quick disclaimer here, and I always want to be super clear about this. I don't have any financial background whatsoever. I'm not giving you financial advice, and please don't buy or sell anything just because of what I'm saying. I'm literally just a crypto enthusiast who loves making these videos as a hobby. This is all just for fun and education. Okay, so let's dive into this data because it's absolutely fascinating. The key metric that changes everything. Raoul talked me about the most powerful metric for tracking macro market moves, and it's the main reason I'm so confident this market cycle is far from over. He's also got this really compelling explanation for why this cycle is taking longer than previous ones. And here's what's wild. Despite what you might see people saying on social media, we are not in bubble territory yet. Not even close.
All right, so what you're looking at on screen right now is the NASDAQ 100. This is a tech-heavy index in the stock market. Think of all your favorite tech companies bundled together. Now, you've probably heard of the big indexes. NASDAQ 100, Russell 2000, S&P 500. Each one tells us something different about market sentiment. Here's where it gets really interesting. The Russell 2000 tracks small-cap stocks. When people start buying into the Russell 2000, it means they're willing to take on more risk. They're going further out on that risk curve. And guess what happens? Every single time this occurs, alt season explodes. I'm not kidding. Historically, every few years when we see this pattern, altcoins absolutely go bananas. That's why we pay attention to this stuff. The tech connection that makes perfect sense. But there's more. The NASDAQ 100 has an even stronger connection to crypto, and honestly, it makes total sense when you think about it. Crypto is tech, right? And the NASDAQ 100 is packed with tech companies, so of course they're going to move together. What Raoul shared goes all the way back to the 1980s, and his analysis is crystal clear. He wrote, "No, it's not a bubble in tech stocks. We are less than one standard deviation from the trend." The dot-com comparison. That'll blow your mind. Now, if you want to see what a real bubble looks like, just look at the late 1990s dot-com boom on this chart. We literally exploded out of a decade-long trend channel and went multiple standard deviations above the normal trend line. You can see it clear as day on the screen. The massive run-up and then that brutal crash. That was a bubble. What we're seeing now? We're not even close to those levels yet. This is exactly why I'm so bullish on what's coming next for crypto, and especially for XRP. The data doesn't lie, and if history is any guide, we're still in the early stages of this incredible cycle. The numbers don't lie, we're nowhere near bubble territory. And here's where it gets even more interesting. We're talking about many standard deviations above the trend during that dot-com bubble. Raoul is basically saying, guys, we're not even close. Right now, we're less than one standard deviation from the trend. He's absolutely insisting this is not a bubble, which gives us yet another solid reason to believe we're not entering a bear market. This cycle is far from over. Breaking down the PE ratio misconception. Now, some people love to throw around the PE ratios are at bubble valuations narrative, but Raoul breaks this down brilliantly. He explains that during currency debasement, the P price rises due to debasement more than the E earnings, which stays anchored to GDP growth. So if debasement is running at 11% and GDP is trending at 2% over the same period, then PE ratios naturally rise by about 9%. Makes total sense when you think about it, right? This means PE ratios can literally double over 8 years or so. It's what he calls the denominator effect. So those scary PE numbers? They might not be as scary as they seem. The Bitcoin pattern that changes everything. Here's where it gets really exciting. Bitcoin is also less than one standard deviation from its trend. But historically, it usually hits two standard deviations before we see a real peak. And what's driving all of this? The ISM business cycle. That's the black line you're seeing on the chart. Raoul points out that the ISM business cycle has been pretty lackluster so far, and you can totally see that correlation. The one metric that rules them all. Guys, this is what I've been talking about in my videos over and over again. This ISM business cycle indicator. This is the metric I keep referencing. And here's the kicker. We have never had the end of a crypto market cycle without this thing absolutely going ballistic first. So when people say this time is different because we might be looking at a 5-year cycle instead of 4 years, I'm like, hold up, you're looking at the wrong thing. Why this time is different misses the point. The time frame isn't what matters most. It's global liquidity that controls these cycles and that ultimately impacts the ISM business cycle. If we don't see that ISM indicator explode to the upside this cycle, then it would truly be different. But whether that happens now or in 2026, like Raoul thinks is likely, it doesn't matter. As long as it happens, we're following the same pattern. People get caught up in the timeline and think, oh, if it goes into 2026, this time is different. But no, you're focusing on the wrong metric entirely. It's not a this time is different situation if it extends into 2026. That's exactly why I keep highlighting this indicator. The liquidity factor that explains everything. And here's the technical reason behind it all. Raoul explains that there's less need to add liquidity in the US right now because most debts have been extended to 5 years and won't need to be rolled over for the next 12 months. The $10 trillion bombshell. So here's where it gets absolutely wild. If we're looking at a 5-year cycle instead of 4 years, what does that do to liquidity? It delays it. And that's the entire point Raoul is making here. He's saying there's less need to add liquidity in the US right now because most debts have been extended to 5 years and won't need to be rolled over for the next 12 months. But get this, that's $10 trillion that's going to need refinancing. Folks, do you see why I find this argument so compelling? I mean, we'll find out if he's right as time goes on, but wow, $10 trillion. Think about this for a second. What do you think happens when that massive amount gets refinanced? Can you imagine how much more money is going to be flowing around the system? And how do you think that impacts the business cycle? How does that change people's attitudes toward investing in risk-on assets like stocks and crypto? I mean, DUH, right? Whether this actually plays out or not, you can at least see the logic behind it. It's pretty straightforward when you break it down. The liquidity timeline that explains everything. Raoul continues, thus the bulk of liquidity is delayed, and forward-looking indicators suggest it lies ahead. Financial conditions give us a 3-month lead, and that in turn leads to ISM. And there's that ISM business cycle again, the black line on your screen. This is exactly why I keep highlighting this indicator. Liquidity leads directly to this metric, and the data is honestly pretty compelling. Why I'm still bullish despite the noise. So when I see people just looking at charts and saying, oh, everything's bearish now, I'm like, are you sure about that? What about these macro conditions? Don't they matter? I think they absolutely do, and I find this analysis very compelling. But here's the thing, I'm totally open to being wrong. I want to hear your counter-arguments. If you have a case against this thesis, I'm genuinely all ears. Please articulate something in the comments because I'm absolutely willing to hear out anyone who thinks this doesn't make sense. Honestly, I haven't seen a strong argument against this yet, and I'm actively looking for one. I'm always searching for thoughtful discourse on social media because brilliant, data-driven people like Raoul with decades of experience actually share what they think. And listen, if I can find a compelling argument against this, I'll absolutely share it on the channel. I'm not here to just lock into one viewpoint and keep pushing the same narrative. I want to share diverse perspectives because my goal is simple. I want to believe whatever is true. Whether it's good news or bad news, I want to live within the confines of reality. I want to believe as many true things as possible. That's just how I approach this stuff. But so far, I haven't seen a solid argument against this particular thesis. The NASDAQ connection that seals the deal. Finally, Raoul wraps up by saying all this drives number go up. The NASDAQ 100 has a slight premium currently, but that's totally normal at this phase of the cycle. And he's absolutely right. Look at that pink line on the chart. That's the NASDAQ 100, and you can see exactly what he's talking about. The historical pattern that's impossible to ignore. And here's where it gets even more fascinating. You've got liquidity shown in black on this chart. Yes, the Nasdaq 100 is currently above it, but let's take a trip back in time. Go back to the last cycle, same exact story. The Nasdaq had a lead until suddenly it didn't, right? Then look at the cycle before that, same thing. Nasdaq 100 had that lead, then boom. Go back to the cycle before that. Yep, same pattern again. This has happened multiple times, folks. So here's the thing, this part is actually completely normal. If we're just dealing with a lengthening cycle due to debt refinancing, which drives global liquidity and the business cycle, then all of this makes perfect sense. Why most crypto investors are missing this? Do you see why I'm taking the time to break this down for you? Because most people simply don't understand this thesis. I mean, it's fairly popular in crypto just because Raoul Pal is talking about it. But honestly, most people in crypto have no idea what this actually means. They have no freaking clue. They look at these charts and just see a bunch of gibberish on the screen. That's exactly why I want to spend time explaining this. Because if you're like me and what matters most is XRP absolutely rocketing and melting faces, then we need to not be in a bear market. We need to not be in a bubble. We need to keep rampaging higher. And yeah, I want that to be true, but is it logical to believe that's what's probable? I still firmly argue yes, absolutely. This is one of the strongest arguments supporting that view, which is why I'm making this entire video about it. The XRP connection that gets me excited. If you want XRP to melt faces and make you filthy rich, this is the type of analysis that shows how we get there. Because if Raoul is correct, we're going to have a full-blown, face-melting alt season sooner rather than later. The Bitcoin decoupling pattern that proves the point. Now, here's another incredible pattern. Raoul points out that Bitcoin usually decouples to the upside at this point in the cycle. And this chart goes all the way back to 2013. You've got Bitcoin in pink and total liquidity in black, and just look at that correlation. Let me clarify something important though. When we say decouple, people get the wrong idea. They think it means Bitcoin permanently breaks away from everything else forever. No, that's not what's happening here. Raoul is showing that Bitcoin can decouple over short time frames, and then you can see strong correlation again after that. That's exactly what this chart demonstrates. Look back at the last market cycle, same thing happened. The cycle before that? Yep. Even going back to 2013, it's the same pattern over and over again. We're right at the moment. So we're at that phase right now where Bitcoin is about to run with itself, just like you'd expect based on global flows and macro trends. Even though we haven't seen it happen yet, it makes total sense that we're at the phase where it's about to explode. That's exactly what Raoul is arguing here, and honestly, the historical data backs it up perfectly. The correlation numbers that will blow your mind. Okay, folks, this next part is huge and kind of matters more than a little bit. The Nasdaq 100, ticker NDX, which some people are calling a bubble, has a 96% correlation with Bitcoin. And Bitcoin? It has a 90% correlation with what Raoul calls the DM, total liquidity index. That's a big correlation right there. Now I know. Correlation doesn't necessarily mean causation, but in this case, I think there's some serious causation happening here. Call me crazy, but Uncle Moon Lambo's got a little hunch here, folks. I've got a tiny baby boo hunch that this isn't just coincidence. The most dominant factor in market history. Raoul continues with this absolutely mind-blowing statement, which makes total global liquidity the most dominant macro factor maybe in the history of markets. And this is driven by demographics, which drives debt. Folks, that's why I keep saying what I'm saying about understanding markets on a macro level. Look, there's no single metric that's the end-all, be-all. I'm not claiming the business cycle or global M2 or anything else is perfect. But I am saying this is about as close as you're going to get to understanding what really moves markets. When Raoul says global liquidity is the most dominant macro factor maybe in the history of markets, yeah, exactly. I recognize that, and that's why I've been saying for months now that while there's no perfect metric, this is as close as you'll get. Raoul is effectively arguing the same thing I've been pushing. This is the dominant factor, 100%. It's not just about the US. Here's where it gets even more interesting. Raoul points out that debt drives liquidity via debasement. But this is not just a US game. He reminds us that back in 2017, the Fed was raising rates and doing quantitative tightening. Fed net liquidity was flat, but China and the UK drove total global liquidity, which meant number go up. Total global liquidity is the game. It's the debasement of fiat currencies worldwide. The rates are too damn high problem. But this time around in the US, as Raoul puts it, rates are too damned high. Remember that old meme? The rent is too damn high. Whatever happened to that guy anyway? When rates are this high, we really need to allow liquidity to fill the void. No kidding, right? The COVID extension that changes everything. And here's the kicker. Raul explains, that is why the cycle is lackluster thus far, because 2025 was not the year of the big debt rollover. Thank you, COVID, for allowing average maturity to be lengthened by a year as rates hit zero. So there you have it. The debt refinancing got extended out by a year, and he's arguing that's exactly why we're seeing what we're seeing in the markets. Raul saw this coming a long time ago. The crazy thing is, when did Raul start arguing this? I don't want to put words in his mouth, but I'm pretty sure it was close to a year ago, maybe longer. He saw this coming from way out. And here we are now, getting to the end of 2025, and more people are finally getting on board with the idea of, oh yeah, we're running out of runway here. Looks like this is probably going into 2026. I haven't seen everyone jump on that bandwagon yet, but there are definitely a lot more analysts saying, yeah, it really looks like this is going to roll into 2026. The man was ahead of the curve, and now reality is catching up to his analysis. My take on predictions. Spoiler, I don't make them. Now, listen, I don't make predictions on this type of stuff myself. I mean, I reserve the right to, but I just haven't, and I tend not to. I prefer to just share the data with you so you guys can come to your own conclusions about what you think is plausible. But again, I do find this analysis incredibly compelling. So yeah, Raul's blaming the pandemic for lengthening the average maturity of these loans by about a year when rates hit zero. And then he drops this bomb. So probabilistically speaking, things have shifted. The "this time is different" trap. Here's where Raul gets really philosophical. He says, I am fully aware that this time is different is a powerfully dangerous symptom, but our view at GMI is that it is not different. It is the same because the cycle is based on debt maturity. Folks, pause and note this. Earlier in the video, I spent time talking about this exact concept of this time is different because I knew how he was going to wrap this up. People are arguing this time is different and asking, what do you mean it's not different? It's a year later, that's different. Okay, sure, that's technically different. But that's not what matters. That's not the thing that drives markets. When you say this time is different, there should be something fundamentally that shifts. And it seems clear to me, I don't want to put words in Raul's mouth, that time itself isn't a core factor. Time just happens to pass based on the underlying things that actually matter. Global liquidity, the business cycle, debt refinancing. That's exactly the point he's making here. This time is not different, even if it's now a 5-year cycle, because the underlying things that drive markets haven't changed at all. Raul's personal strategy revealed. Then Raul gets personal about his strategy. Still taking lifestyle chips off into a strong rally to new highs, and ETH, Solana, SUI, will hedge the risk of being wrong. I never go through the cycle with no exposure, but instead prefer to compound and add when prices fall. Translation, he's taking some profits along the way, but staying exposed to crypto because he believes in this thesis. And here's how he wraps it all up. It's all to play for. There are no bubbles. He ends with the same message he started with. No bubbles here, folks. That's not what this is. The best is yet ahead. What this means for XRP holders. So to wrap this up, if Raul is indeed correct, then we're going to get ours as XRP holders. You should expect your altcoins in general to go on an absolute freaking rampage compared to where we are right now. Because the best is indeed yet ahead, and it doesn't make sense to be fearful here. The data supports optimism, the patterns are there, and the macro conditions are setting up for something incredible. What do you think? Are you starting to see how all these pieces fit together? This analysis has me incredibly bullish about what's coming next. Drop your thoughts in the comments. Do you agree with Raul's thesis, or do you see holes in the argument? Let's keep this discussion going.